Welcome. In this video, we will discuss about Systematic Transfer Plan or STP as it is called in the mutual fund industry. What is a STP? STP is an option to transfer money periodically to buy a volatile asset, helping us get an average price for the asset, and it is similar to SIP. In SIP, we invest a fixed amount over regular intervals from our savings. In STP, instead of the contribution coming from our savings, it comes from a bulk investment made in another scheme. Why we need STPs? Markets are not always up. It goes in three directions: up, down, and sideways. If someone wants to invest bulk money into the market and it is not going to go up, his or her investment will have negative returns for some period. Like here, buying at some level and market goes down, it can have negative returns. In such a situation, instead of investing bulk money in one go, it is good to have a phased entry which will give us the advantage of averaging. This is where STP comes in handy. We can park our bulk investment into a debt fund which will give us fixed returns, and from there have a systematic transfer of small chunks of money into equity fund, which will help us add more units when the market is lower and lesser units when it is higher. Thus, STP helps us get an average entry price by capturing the downside move in the market without the need to time the entry. We entered here at this level by moving into a debt fund. From there, we are getting into the equity fund by moving small money through the STP route. As we can see, these green lines are STP is happening in the fund. As the market is going down, STP is capturing the downside. When it hit the bottom, we are already in, and we have an average which is almost at the half of the move from top to bottom, thereby getting our investment ready for the next rally with a lower entry price, giving the potential of very high returns when the markets go up. After this bottom, market went up substantially and we had very good profit potential. This chart is of Sensex in 2017. When we need STPs, there are two situations when a STP is required. First one is when you have bulk money to invest and market is expected to be in a sideways or down. Second time is when the market is at top and you can take profits and re-enter into the same fund. Let's say you have bulk money to invest and the market is not likely to go up soon. Instead of waiting for nailing the bottom, which is difficult to identify and chances of missing the bottom is very high, you can park the bulk money into a debt fund which will give fixed income and is also safe. From there, move the money by setting up a STP to transfer a fixed sum of money at a fixed interval, which can be daily, weekly or monthly, into an equity fund which will give higher returns. Let's come to the second condition. In the second option, you are already invested in the market and it has made a big move like we see here. Now it is time for the market to take rest or correct, where you can use the opportunity to exit from your investment, move the funds to a liquid fund of the same fund house and set up a STP through which you can move back the redeemed money into the same equity fund at a lower level, thus helping you make some additional profits while still being invested in the same scheme or fund. You can see here at the top we exited. As the market moved down, we are again re-entering into the same fund by STP route. These blue lines here is capturing the downside moves in the market. When the funds are completely transferred, our holding cost will become lower than the prevailing price in the market, and also we would have earned a small profit from being invested into the debt fund as the market went down, which will be a bonus to us. When STP is helpful, STP is used to capture downside moves and sideways moves in the market. If the market is going to be bullish or going up, then it will not be helpful to do a STP. Doing so will only become counterproductive. That is, instead of taking maximum gains when the markets are going up, we will end up taking average profits only. This brings to a condition where the investor should be able to judge the future and determine the direction of the market before deciding on the STP route of investing. Now, let's look at a comparison between STP and bulk investing. Let me explain this with an example. Say you have 10 lakhs to invest. You want it to be invested in an equity mutual fund for a longer period, and you know that the market is going to give very good returns. At the same time, you have a lot of events coming up in the market which you feel can cause some downward price moves too. By events, I mean it can be an election year, it can be a war situation, might be not in our country, maybe in some other country too, which can bring pressure on the economy, or some political uncertainty looming in the economy. Let's say you invest all your money in one shot into the equity fund, and from there the market takes a dip before going up and reaching your goal. When it takes the dip, you will get worried. Say you invested at 120. It goes down to 100, where your mind voice will now say, you should have waited, not entered at whatever price you entered. This situation can make you take some wrong decisions too. And after the drop, the market comes up and reaches 200 rupees, thereby giving you a 80 rupees profit on your investment. Here, ideally you made profits, but only condition was that after we entered, it went down and gave us some nervousness. Now, let us look the same investment through a STP route. You foresee uncertainty in the market, so you invest your money into a debt fund, set up a systematic transfer plan to transfer 1 lakh per week for 10 weeks from your 10 lakhs of investment. In this period, the price gradually moved down and moved up. It was at 120, it went to 100 and then back again. Now your average cost of entry is 110 and not 120. This is because of STP. You can see these blue lines which is capturing the downside price move. Along with this, it also took 10 weeks for the money to move from liquid to equity. In that period, we have also earned a small return from the debt fund, which becomes a bonus to us. Now, as the price moved to 200, the same place where we saw in the bulk investment too, your profit is now not 80 rupees, it is 90 rupees. Thus, STP helps in getting lower entry price when the market is in sideways or down before going into a bull run. STP only in same fund house. As of now, transfer of funds between fund houses are not allowed in India. Hence, you have to select both the schemes in the same fund house. That is, a parking fund and the destination equity fund should be in the same fund house. Only then STP is possible. Exit load free funds for parking. The parking fund should ideally be a zero exit load fund. Else all the small earnings that we will make through the debt fund investment will go off in charges itself. Ideally, select a liquid fund or an ultra short term fund for parking. Destination fund should be long term. The fund you select for moving money from debt to equity should have a consistent performance and should be a long-term fund. Only then money can grow better. If you are going into sector funds or thematic funds, it will not serve the purpose as those funds require perfect timing to make money. Decide on the frequency and amount. How much and how long to do STP depends on the market conditions. If the market has just reached the top, do STP for a longer period with smaller amounts. If it is already down and has uncertainties, based upon the condition, shorter or longer duration have to be selected. Using STP is a very good option for investing in uncertain markets, which helps in maximizing profits. Let's sum it up. STP is used to average cost of production in a volatile market. It is like a SIP, will be useful when you have bulk money to be invested. It is useful only in down and sideways markets. Parking fund should not have exit loads. Destination fund should be a long-term fund. Both schemes should be in the same fund house, and it needs judgment to decide on the frequency of the amount. Happy investing. Thank you.